right, welcome back to the Know Your Numbers REI podcast. This is your host, Chris McCormack, and we have created this show to help you, the real estate investor, the entrepreneur using real estate to lower your taxes in order to build your confidence in your decision making, right? We know that numbers are the backbone of your business. If you don't know your numbers and if you're not profiting, if those numbers aren't showing a profit, then your business will soon not exist. Without profit, profit is the lifeline of your business. It's the oxygen that makes your business run and breathe. And so we know that numbers don't come easy to everyone. We also know that numbers usually bring with them taxes, and the discussion around taxes is really a discussion around numbers, and numbers meaning money in this situation. And so we know that not everyone has confidence in their numbers, confidence in their tax plan, their tax position. And so we are here to build your confidence, to eliminate the uncertainty or the frustration or the confusion that you might have around your taxes by educating you, by bringing knowledge to your ears and allow you to make more confident and educated decisions. And whether that means you are a client of ours and this just helps grow your accountant relationship, or whether you're just somebody who's tuning in and listening for the first time, we appreciate you being here. And we know that our goal is to provide you with the highest value. And if you get value, then it helps us if you share it with a friend and somebody that might also need this value, because we know it's lacking out there. And we live in a society that has allowed us to share things so quickly. So be a friend to a friend and share this if it does provide you with value. Today, we're going to be talking about a much needed topic of conversation, and that has to do with debt, specifically debt when refinancing, and just the importance of the record keeping process of that refinance or the mortgage that you might take out, or maybe you take a loan out on some sort of insurance policy. And we're going to be talking about the tax implications of that decision, and also why it's important for you to know how that is being categorized in your books and on your tax return. Because as you'll see in this conversation, debt is typically a non-taxable source of financing. However, if it's not categorized properly, we have seen and come across many investors and business owners who are at risk of paying taxes on that debt unknowingly because of a lack of surefire bookkeeping. So if you've ever thought about refinancing, maybe you refinanced in the past 6 months, right? We're in July now, so it could be a relevant topic for you. If you are refinancing, we know the refinances are few and far between in today's market, but maybe you took a loan out on an insurance policy, right? We know that a lot of people are using cash value life insurance, and it operates under the same tenet, I guess, or same principle in the fact that it should not be taxed, but because there's a lack of communication between you and the bookkeeper, you and the accountant, you and yourself, or just a lack of knowledge in how you're supposed to categorize that, sometimes it can find itself in that taxable income depending on the way that you are operating your bookkeeping, and we want to avoid that. So for starters, what is a refinance? A refinance is simply a new loan that you get out on your property, right? We say that maybe you buy your property for $100,000, you fix it up, and now it's worth $150,000. You can refinance that piece of property, get an extra $50,000 out of the equity that you've now built up through the rehab work, and you can use that $50,000 as you please. Obviously, when you refinance and you take out more money, your interest payments, your loan payments are going to be higher. But the idea is that by adding that value, you are able to recover more from the rent that you are generating from that appreciated piece of property. Some people, there's a whole market of real estate that is focused on this art of refinancing. It's called the BRRRR method. You've probably heard of it. Buy, rehab, refinance, rent, and repeat. The refinance piece is that part that offers some great tax benefits, especially when interest rates are favorable. Right now, a lot of people might have bought property in the 2020, 2021 period when interest rates were a lot lower. And so refinancing might not make the most sense because interest will be higher, right? If you bought at 3% and the option now is to refinance at 7%, you're going to need a lot more to justify that because your interest payment will go up. But a factor in that decision would be whether you tap into that equity tax-free. And through the power of refinancing, you can get tax-free dollars, right? And we've done this a lot with our clients who have refinanced and tapped into equity that they have in their home, and it's given them the ability to expand their portfolio. However, if they weren't working with us, or they were doing it on their own, or maybe they were working with a bookkeeper or an accountant who did not have the expertise necessary for that refinance, chances are they could have been taxed on such a transaction, right? Because debt is not taxed. If you go and get a loan for $300,000 from the bank, they're not going to withhold taxes on it. However, if you then categorize that $300,000 in your books as income, well, then you're going to be taxed on it. And so that's a huge issue that we see oftentimes because of just a lack of education and a fear, because none of us want to be on the wrong side of the IRS. None of us want to be found paying less taxes than we should have been. And sometimes we come across people that are doing their own books and they don't know how it's categorized. So they just put it in as income, or maybe QuickBooks, if you're using software, QuickBooks or whatever software you're using, categorizes it as income because it's money into the bank. You took that loan and you put it into the bank just for financing, right? Maybe less so for a mortgage, but more so for a business loan. They give you $300,000. It goes into your bank account. You use it as you will. If your software does not know that that's a loan and sees it as money in, they could accidentally or unknowingly categorize it as income. $300,000, your bottom line goes up $300,000. You are now paying taxes on that $300,000, which will put you in the 24 or 32% tax bracket. 32% of $300,000 is almost $100,000, right? So this quickly can get costly if you're not doing things correctly. And that's why we want to have this conversation with you, because most people, you guys are educated. I love real estate investors because you guys have a strong knowledge, right? A lot of you come to us and you say you know enough to be dangerous, which is great. I love working with people who have insights into the tax code because it makes my job more fun. We're able to strategize and come together as partners and just see what's going on in the business and decide what is best moving forward from a tax and financial perspective. And I get that in the real estate investing because you guys know numbers, you guys know ROI, cash on cash return, cap rates. Like, you guys have a knowledge that isn't something to be taken lightly or taken for granted. But at the same time, there's a lot of things that come up that, if not done correctly, can cost you, right? You might know that debt is not taxed here in the United States, but if you don't account for that debt properly, you're at risk of paying taxes on money that you don't need to pay taxes on. The same is true for some retirement account withdrawals, right? We had a client recently, and this is a bit off topic, but he had a retirement account withdrawal. And based on the conversations that we had, we were able to determine that withdrawal should not be taxed. It was an inherited annuity. It was the last part of the inheritance, and therefore it was part of the principal. But the actual documentation that we received from the bank that executed that distribution did not say that it was what it was, right? They left some information out, right? They showed like a distribution of, I think it was $60,000. And then on the form, it showed taxable amount. It didn't show anything. It didn't show zero. It didn't show 60,000. So it was really up for interpretation how much of it was taxable. But had we not had that conversation, the computer system would have determined that, hey, this is a $60,000 annuity distribution. It's taxable. Here's a $20,000 tax bill. And because we had that conversation and knew the character of this income, we were able to determine and really tell the computer what was the taxable amount versus the non-taxable amount. And it saved our client $20,000. So this is real. And we might know that form of annuity, or in this case, that form of refinancing, should not be taxed. But if you're leaving it up to a computer or a bookkeeper who might not be knowledgeable on these things, then you are at risk of overpaying in taxes. And that's not something that you want to do. We know that the General Accountability Oversight, the GAO, they say, and this was a survey done probably in 2017, 2018, every year, Americans overpay $1 billion in taxes. It's hard to believe when you think about the debt that we're in and the amount of money that we do not have as a country. But it is true that citizens unknowingly overpay $1 billion in taxes. And this could very well be part of the reason, because yes, you might know that a refinance should come to you tax-free, but again, if it's not categorized properly, if you're not working in relationship with your accountant and your bookkeeper to know that that's being categorized properly, it could go under the radar and be improperly recorded in your books, and that is the last thing we want. So it's important for you to be working with an accountant, with a CPA, with an EA, with a tax planner, somebody who works with you around the year and has a relationship with you so they know what's going on in your business, so that you're not subjecting yourself to these taxes that you shouldn't be paying. We had two clients actually who had a very similar experience. He is investing in rentals, he's investing in flips, he's investing in BRRRR properties, and he refinanced the property and he rehabbed and then he refinanced. And he knew, based on what you hear in Bigger Pocket and at some of these meetups that you might be attending, that refinancing is a tax-free event and you should not pay taxes on that. However, we went into his books and saw that there was $50,000, $60,000 that was unaccounted for. And at the time, it was uncategorized income. And had we come to him, or had he come to us in March or April of the following year and just asked for his taxes to be prepared, Well, that uncategorized income, there's a good chance that that would have been categorized just as income and not inquired about. And the accountant might not have determined the actual character of the money in that was on his books as uncategorized income. That's $60,000 that would have been improperly displayed, improperly categorized on the tax return as income, when in reality it was a refinance, which again is tax free. So we were able to get it out of uncategorized income, put it into the owner's equity, because it technically is equity that has been developed in the business, and that saves you, call it $15,000, right? If you're at the 24% tax bracket, 15,000 is a quarter of 60,000, so it comes out to just about that much. And so these are the things that you need to know, right? It is a great benefit of the United States tax code that debt is not taxed, right? It gives us the ability to tap into the equity of our properties that we've developed, or it could even give us leverage or the ability to buy that first property, right? If I go and have a $500,000 property and I can get a loan for $500,000, but I have to pay taxes on a portion of that, well, I'm still worse off than I was, right? Because now I'm paying taxes and I can't get the property. But because of the way that our tax code is set up, you don't have to pay taxes on debt, and you can use that to invest in properties that will generate more income, right? Refinancing means that you've developed a property that allows you to generate more income, and now you can take money out of that property to go out and expand your portfolio even more. It's a great benefit, but if you're not meeting with your accountant on a regular basis, if it's not being categorized properly on your books, on your records, there's a good chance that it could be categorized improperly, and you are paying taxes on money that you don't pay taxes on, and you end up in that debt of the $1 billion that is overpaid every year by Americans. And we want to avoid that. And so we're educating you, but it's also important for you to have a relationship with us or your tax planner or your accountant so that they know that $60,000 wasn't just income you made and you don't know what kind of income it is. It's a refinance that should not be taxed. So don't let it be taxed. And that comes in the form of relationship and understanding what's going on in your business. We had another client who less refinance, but more using insurance to grow a real estate portfolio or invest in other forms of real estate. And similarly, they were doing their books on their own and they didn't know how to categorize this transaction. They had heard that the insurance that they were using, cash value life insurance, this happened to be a whole life policy. They had heard that there were tax benefits and you could tap into that policy and not pay taxes on it, but they heard it from an insurance broker and they were not hearing back from their accountant and they were on the hook for doing their own books. Well, they signed on with us and we uncovered this in our conversations and in our quarterly meetings. And now we know that because we have the knowledge about insurance and because we know that insurance proceeds are also not taxed and debt is not taxed and getting loans are not taxed, well, your loan on your insurance policy should not be taxed. And so we're going to make sure that when we come together in their bookkeeping and go to prepare their taxes, that they're not putting that $50,000 loan that they took out on their insurance policy in their books as income, right? Because it's not income. But if you don't have that relationship, if you don't have that knowledge, if you don't have that confidence, you could find yourself overpaying in taxes and categorizing income that's not really income and getting yourself into a costly endeavor that you should not be in the first place. So it's important for you guys not only to know this, that debt is not taxed and that insurance proceeds are not taxed, but it's also important for you to be working with the right people so that they are aware of what's going on in your business, so they are aware and they know that this is not a taxable event. And if they don't know that or they're hesitant to do that, then it's time for you to find a new accountant, right? And I get it. People are overworked. Accountants are overworked and there is a shift in the industry. But if you find that you're only meeting with your accountant March or April and they're rushing to get it done so that they can get it prepared and that you don't have to go on extension, there's a good chance that things are being missed and that you should be looking for a more proactive relationship, a more partnership related endeavor rather than just a preparation and transactional based endeavor. So this is a big part. The big takeaway is that one, debt is not taxed. Refinancing can be a great benefit. Getting debt can be a great benefit because it allows you to go out and get properties that will cash flow. Obviously, in today's environment, it can be tough. I'm not telling you go out and get a new loan out on your property because you added $5,000 worth of value and now it's worth a new loan and higher interest payments. That's not what I'm saying. I'm saying that if you are refinancing and you're tapping into some of the tax benefits that come with refinancing and then also growing your portfolio through the power of refinancing, just be sure that yes, you know that debt is not taxed, but also you have a partnership that you can rely on and confidently say, I took $50,000 out on a refinance. I took $100,000 out on a refinance. And I know that I'm not being taxed because my accountant and I are working diligently together And we have a partnership-like relationship, and we've talked about this on multiple occasions. So if that's something you're missing, we'd be happy to look into your records. We offer a free consult where we dive into your previous tax returns, your bookkeeping, everything that makes your machine run, and we identify any mistakes or missed opportunities that might have come over the previous couple of years. And that's completely free. It's our gift to you. It's a great way to at least see if there's things that you're missing or could be doing better. And if it turns out to be a good fit, then we'll obviously let you know what that looks like. But we don't work with everyone. We want people who are willing to take our advice, who are willing to take action on that advice, willing to do what it takes to save on tax. And we know that that's not everyone. So if that does sound like you, feel free to fill out the Calendly link that is often in the show notes, or reach out to me on all forms of social media, Instagram, Facebook, LinkedIn, and we will be sure to get somebody from our team in touch with you so that we can help you pay less to the US government, keep more money in your accounts, and grow your portfolio in a confident manner. So until next time, God bless you and keep moving forward. This is the Know Your Numbers REI podcast with your host, Chris McCormack of Better Books Accounting. We so appreciate you tuning in and wish you nothing but the best in the week ahead.